Bitcoin derivatives markets recorded new highs in trading activity as Bitcoin options open interest surged significantly, indicating rising institutional engagement. Major exchanges reported FTX and CME platforms seeing record volumes tied to ETF-linked hedging strategies. Options activity suggests traders are layering directional risk while balancing exposure through structured hedges. Retail traders also increased participation specifically in out-of-the-money Bitcoin calls, anticipating rallies. The combination reflects deeper capital layers entering crypto derivatives markets beyond spot holdings. Goldman Sachs and BNY Mellon jointly announced plans to tokenize money market funds through blockchain technology, marking a pivotal shift in traditional asset infrastructure. Their initiative will issue tokenized units on private ledgers compatible with major institutional custody services. This collaboration underscores broader bank participation in hybrid financial innovation. It reflects global pressure to modernize settlement systems and improve liquidity across funding sectors. Investors see this as a blueprint for integrating traditional safe haven assets with programmable finance tools. CEA Industries, a small publicly traded firm, saw its share price rise more than 800% due to announcement of intent to build the largest publicly traded treasury based on Binance Coin. The company outlined plans to raise $1.25 billion to implement this bold crypto strategy. Retail investor engagement spiked on social platforms, generating trading volume and speculative capital inflows. Analysts caution that such high-risk corporate crypto allocations may reverse sharply if token prices correct. Still, this move signals renewed interest in on-balance sheet crypto plays, even from non-traditional issuers. ECB officials issued warnings about the systemic risk of rising US dollar-linked stablecoins in European payment systems, suggesting the Eurozone's monetary policy control could erode. Stablecoins amounting to $250 billion globally may dilute the ECB's influence over interest rates and money supply tools. The authority emphasized accelerating development of a digital euro to counterbalance private token dominance. Policymakers flagged that interest-bearing stablecoins could drain traditional deposit bases from regulated banks. These regulatory signals now influence institutional stablecoin issuance strategies globally.
SUI token reversed earlier gains, dropping approximately 6% from intraday highs to below $4.10, following a spike earlier to $4.44 and subsequent heavy sell-off. Traders highlighted heavy volume consolidation and resistance forming near $4.20, with technical double bottom patterns around $4.08 suggesting potential stabilization. The pullback occurred alongside broader crypto weakness driven by strengthening US dollar index. Altcoins broadly mirrored profit-taking dynamics, though long-term sentiment remained intact across major digital asset networks. Analysts view SUI's move as short-term rotation rather than systemic risk. Ethereum capital inflows continued as BTCS acquired an additional 14,240 ETH, increasing its balance to over 70,000 tokens worth approximately $271 million at current prices. This accumulation reflects continued institutional confidence in Ethereum's long-term utility. Ethereum is outperforming the S&P 500 by over 20% across the past week, underscoring decoupled strength in the token versus equities. Analysts attribute ETH demand to on-chain utility and developer momentum backing DeFi and staking yields. Institutional accumulation flows now represent structural demand, not speculation. Institutional inflows into cryptocurrency investment products reached a July total of $11.2 billion so far, with Ethereum products leading ETH capital absorption by institutional investors. This level exceeded prior annual inflows into Bitcoin, signaling a shift in preference toward Ethereum among large allocators. ETF inflows into ETH-based products reflect structural rotation toward utility tokens versus inflation hedge assets. Market participants note that rising inflows helped ETH reclaim and sustain the $3,900 level. Continued inflows support optimistic price projections for ETH into year-end. Bitcoin market dominance remains centered on long-term holders, with supply growth slowing due to odd halving cycles and lower issuance rates. Analysts point out that supply entering circulation now hovers around 450 coins daily, compared with prior issuance rates nearly double that size. Reduced supply growth paired with rising demand pressure supports bullish thesis for Bitcoin stability above $118,000. Derivative market shifts support a transition toward tactical hedging rather than volatile trend chasing. Institutions are viewing Bitcoin as convertible capital, not speculative vehicle.
Macro cross-asset sentiment remains calm. Equity futures rose modestly following US-EU trade deal headlines that reduced tariff risk. Major US indices extended record streaks, with S&P 500 and NASDAQ hitting fresh monthly highs. Commodities remained steady as gold retreated slightly amid lower safe haven demand, and oil prices remained range-bound. Institutional positioning favored equities and core crypto products over high-risk altcoins. Coordinated capital flows across markets suggest strategic rotation rather than panic-driven movement. Retail sentiment diverged from institutional caution as meme-style trade activity increased around token treasury themes and speculative alt assets. CEA's rally spurred retail investors into leveraged platforms and social-driven trading behavior reminiscent of earlier cycles. Margin debt hazards re-emerged but remained contained within behavioral segmentation. Institutions largely bypassed these high-risk flows, focusing instead on compliant ETF and token-tier capital. This bifurcation is persistent: structured allocation versus speculative tempo. Tokenization continues as a broader narrative as asset tokenization efforts expand beyond stablecoins into money market funds and commercial securities. Industry leaders project tokenized assets could exceed $2 trillion by 2030 under base case adoption scenarios. Initiatives from banks like Goldman and BNY highlight a push toward programmable finance in mainstream instruments. Tokenization models now balance regulatory compliance with liquidity innovation and fractional ownership. Digital innovation aligns with macro securitization timelines for asset delivery modernization. Stablecoin legislation via Genius Act continues affecting institutional planning as U.S. stablecoin regulatory clarity drives broader issuance pipelines. Institutions are preparing stablecoin issuance frameworks under dual federal state supervision guidelines. Market feedback suggests faster settlement cycles and liquidity is growing among licensed token issuers. Regulators also monitor potential bank deposit erosion tied to interest-bearing stablecoin models. Corporate treasury architects are increasingly considering tokenized cash reserves to optimize capital deployment. Equity analysts noted divergences in corporate earnings themes as tech-linked companies prepare results amid macro transition uncertainty. Firms holding significant crypto treasury positions are gaining valuation support regardless of macro volatility. Meta, Coinbase, and MicroStrategy received interest for integrated crypto strategies as earnings catalysts. Digital asset exposure is increasingly weighted in equity valuation peer sets. Market participants now infer that crypto strategies may drive premiums in select equity sectors. Emerging markets' currency resilience continues as capital flows stabilize following trade pact optimism. The yen strengthened modestly, while the US dollar index traded near a multi-month high, pressuring speculative token performance. Currency hedging activity increased across emerging markets' equity-focused portfolios. FX flows largely mirrored equity rotation themes rather than speculative bond interventions. Investors emphasize strategic balance between currencies and digital asset exposure. In credit markets, corporate bonds feature stable issuance trends with controlled spread dynamics even amid rising margin debt and retail speculation. Credit default swap pricing remained benign, indicating no perceived jump in risk premiums. Fixed income portfolios are gradually positioning for tokenized treasury products as stablecoin clarity advances. Mortgage rate sensitivity continues to limit household leverage across key metros. Liquidity remains supportive across credit tiers despite macro uncertainties.
Venture capital sentiment remains conservative but selective in Web3 and blockchain infrastructure funding. While seed rounds slow amid macro uncertainty, institutional Stage B and AI telecom intersects sustain interest. Analysts emphasize capital discipline over narrative-driven fundraising. Infrastructure players focusing on custody, settlement, and security are prioritized over speculative consumer tech. This reflects structural capital repositioning toward compliant ecosystem builders.
NFT assets rebounded as CryptoPunk's floor price surged above $200,000 for first time in months, driven by Ethereum's strength and renewed high-value interest. NFT trading volume reached multi-million-dollar levels across leading platforms. CryptoPunks regained prominence as auction and lending markets resumed activity. Analysts view this as a resurgence of collectibles tied to institutional adoption frameworks. Ethereum's support of NFT liquidity highlights broader ecosystem interconnectivity. Institutional sentiment indicators show Bitcoin support holding near $118,000 technical zones, with ETH bullish consolidation above $3,850. Open interest in exchange-linked options and futures remains near record levels, suggesting hedging demand outweighs speculative complacency. Volatility metrics remain subdued, but directional setups reflect structured capital allocation. Market psychology tilts toward disciplined exposure rather than retail-driven exuberance. This stability signals readiness for calibrated upside entry points. Token issuance platforms like Zodium Markets continue expanding after Series A funding, supporting over 70 digital assets and 20 fiat currencies. Its global infrastructure has been strengthened by regulatory approvals in the Middle East and acquisition of OTC trading channels. This infrastructure expansion reflects institutional demand for real-time settlement and compliance-integrated services. Greater interoperability supports faster capital deployment across jurisdictions. Analysts expect further consolidation among crypto infrastructure firms. In summary, today's market landscape highlights increasing crypto resilience supported by institutional inflows, strategic derivatives usage, tokenization momentum, and regulatory advancement. While retail speculation persists, structural capital flows continue reinforcing long-term trends across equities, crypto, and credit. Institutional focus on stablecoin frameworks, tokenized vehicles, and digital native treasury assets forms the backbone of future finance infrastructure. The divergence from volatile cycles toward disciplined rotation offers opportunity with reduced tail risk. Market participants anchoring strategy and fundamentals stand poised for next cycle benefits.